Good morning. Grab your coffee, pull up a chair, and let's have a real conversation about your money. You've been told for decades that your 401 kilos is a slow, steady climb toward freedom. It's the ultimate set it and forget it strategy, right? You buy the index, you wait 30 years, and you win. But what if I told you that while you've been sleeping, the ladder has been swapped for a roulette wheel?
What if your retirement savings aren't actually being used to build companies anymore, but are instead being used as collateral for a $100 trillion gambling table?
Here is the number that blew me away when I first saw it. $50 billion. That is the annual volume of prediction markets like Polymarket and Kalshi. Now, 50 billion sounds like a lot, but here's the kicker: that represents a 68,000% increase in just 3 years. 68,000%. Let that number land for a second. We aren't talking about a trend. We are talking about a total migration of capital. While the traditional stock market is gasping for air, the world of event contracts is exploding. And look at the players involved. Kalshi, a platform that lets you bet on everything from Federal Reserve hikes to movie box office numbers, just saw its corporate valuation jump 1,000% to $11 billion. Why? Because the biggest brokerages in the country are integrating these bets directly into your retirement apps. The money meant for growth is quietly moving into binary outcomes. It's a yes or no world now. You're no longer investing in the future. You're wagering on it. And this is the part you really need to pay attention to. Think about that next time you check your portfolio. You see a green line and feel safe. But behind that line, the plumbing of the financial system has changed. The stable foundation of the American middle class, the 401k, has been rewired. It's been turned into a chip on a high-stakes table where the house always has a better view of the cards than you do. So how did we get to a point where your financial security depends on a binary outcome in a war zone? Let's break this down. Okay, let's talk about the real problem. I want you to imagine a scenario, and honestly, this isn't science fiction anymore. It's March 2026. You wake up, check your phone, and you see the headlines. The Strait of Hormuz is under a complete naval blockade. Operation Epic Fury has begun. Suddenly, 20 million barrels of oil a day, 20% of the world's supply, just stops moving. Within 96 hours, Brent crude oil isn't $80. It's $150 a barrel. Gas prices at your local station double overnight. Your heart drops, right? You're thinking about your commute, your grocery bill, the cost of heating your home. But here's where the story takes a wild turn. While you're worrying about your wallet, the big institutional desks aren't looking at oil stocks. They aren't buying Exxon or Chevron. Why? Because those stocks move too slowly. In a crisis, this big traditional stocks are slow money. If you buy a stock, you have to wait for earnings, for dividends, for a quarterly report. In 2026, nobody has time for that. Instead, hedge funds pivot instantly to event contracts. They go to a platform and buy a contract that asks one simple question: will the Strait of Hormuz remain closed for 30 days? It's a binary bet. Yes or no. If the answer is yes, the contract pays out instantly. It's like switching from a marathon to a 100-meter dash where the track is literally on fire. These event contracts are designed for hypervolatility. When the energy shock hits and the global stock market loses $3.2 trillion in 4 days, which is exactly what happens in this scenario. The yes bettors make a fortune in seconds. 60% of hedge funds have already adopted these contracts. They aren't hedging against risk anymore. They are harvesting chaos. It's a fascinating, if terrifying, shift in mechanics. We've built a system where the fastest way to make money is to bet on the disaster itself, rather than trying to fix the fallout. It's efficient? Sure. But it's also cold. The math gets very tricky here, because when oil hits $150, the traditional hedges like bonds or gold just don't react fast enough. The only thing that moves at the speed of a drone strike is a prediction market. In a race this fast, who actually owns the finish line and who is just paying for the tickets? Let that sink in. Now, this is the part I find truly wild. We need to look at the global web of information. Most people think markets react to the news. You see a report on CNN, you see a tweet, and the market moves. That is the old way. In the new economy, the market moves before the news even exists. I'm talking about the high-frequency trading firms, the HFTs like Susquehanna and Jump Trading. These guys are the truth machines operators, and they are playing a different game than you and I. While you're waiting for a news alert on your phone, these firms are using satellite-linked AI to monitor the Strait of Hormuz in real time. They see the first ship being intercepted. They see the smoke on the horizon from a thermal sensor 900 miles above the Earth. They see the blockade 90 seconds before it hits the newsfeed. And in those 90 seconds, they are executing thousands of trades on prediction markets. They are exploiting the information gap, the tiny sliver of time between a real-world event and the public's awareness of it. During the first 24 hours of that hypothetical Hormuz blockade, market maker volumes on platforms like Kalshi surged by 600%. 600%, while retail investors, people like you and me, were getting liquidated because our slow trades couldn't keep up. The HFT firms were harvesting liquidity. They aren't just betting. They are performing prediction arbitrage. They are taking the money from your 401 kilo, which is being used by your brokerage as collateral, and using it to fuel their high-speed bets on global instability. It's an interconnected digital lattice where your savings are the fuel for their fire. And honestly, this is the most interesting part of the whole story. These firms aren't just guessing. They are creating the real-time truth. When the prediction market says there's a 90% chance of a blockade, the rest of the economy treats it as a fact. The price of oil moves because the bet moved first. It's a feedback loop. We've created a system where the truth is whatever the most expensive computer says it is. 90 seconds before anyone else knows. If this feels like a high-tech casino, that's because we've been here before exactly 100 years ago. Let's zoom out for a second and look at history's mirror. In the 1920s, there was a phenomenon called bucket shops. These were storefronts where regular people could walk in and place bets on the price of stocks without actually owning the shares. You weren't investing in GE or US Steel. You were just wagering on whether the ticker tape would go up or down. It was massive, it was exciting, and it was incredibly dangerous. By 1922, these shops had an 88% similarity to the event contracts we see today. The problem was that bucket shops decoupled the financial system from reality. They turned the economy into a game of pure speculation, which eventually led to the Great Depression. In response, the government passed the 1934 Securities Exchange Act, which effectively banned wagering on prices without ownership. For almost a century, we agreed as a society that gambling and investing should be kept in separate rooms. We decided that your retirement shouldn't be a bet on a price movement, but a stake in a company's success. But here's the deal. Those rules are being quietly rewritten. Today, the same practice is being rebranded as financial innovation. The CFTC, the agency that regulates these markets, is under immense pressure to allow these contracts to be integrated into every brokerage app in America. What was once illegal off-exchange gambling is now being framed as a risk management tool. They say it democratizes the ability to hedge against geopolitical shocks. Sounds like a miracle, right? Well, not so fast. I know, it sounds dramatic, but look at the data. We are repeating the exact same patterns of the 1920s, just with better graphics and faster processors. We've forgotten why those 1934 laws existed in the first place. We are allowing Wall Street to treat the collapse of our energy security or the outcome of an election as a casino game played with your retirement funds. If the rules haven't changed and only the technology has, where does that leave your savings in a world of endless crisis? History is screaming at us, but we're too busy checking the app. So let's connect the dots and look at your wallet. Why is this happening now? Why is the system so desperate to turn your 401k into a lottery ticket? The answer lies in the numbers that most politicians don't want to talk about. The U.S. national debt is currently sitting at a level where our net interest expense, just the interest, is $1.1 trillion a year. That is more than we spend on our entire defense budget. Let that ratio sink in. We are paying more to borrow money than we are to defend the country. Our debt-to-GDP ratio has crossed the 126% threshold. Historically, when a country crosses 125%, it triggers a sovereign risk re-rating. In plain English, the world starts to doubt if you can ever pay it back. When that happens, the system needs liquidity. It needs a way to keep the engine running, and prediction markets are the ultimate liquidity trap. They provide real-time truth to a system that is fundamentally unstable. Your 401k isn't growing companies anymore because the companies themselves are struggling under the weight of this debt. Instead, your money is being used as collateral for a system betting on the next disaster to stay liquid. Here's the bottom line. The era of the steady climb is over. We have entered a period of the $100 trillion prediction trap. You are being nudged day by day to move your money into a system that rewards the fastest bet, not the best investment. You're being told it's hedging, but in reality, it's a lottery ticket with your future on the line. If the world's largest pension funds are pulling out of traditional stocks and moving into these high-speed hedges, what does that tell you? It tells you that the people in charge don't believe in the slow climb either. Think about that next time you see your grocery bill or look at your retirement balance. In this new economy, you have to ask yourself a very provocative question. Are you the one placing the bet, or are you the prize that everyone else is playing for? The house is always open, and the lights are bright, but the math doesn't lie. Your retirement just became a bet. And in a game this fast, the only way to win is to realize you're even playing. I'll leave you with that. Stay sharp and watch the data.